Welcome, dear traders. Yesterday, the US equity market closed in the red due to the massive sell-off. By the end of the day, all main stock indexes dived down. The high-tech NASDAQ plunged by 23% from its highs. What was the reason for such a sharp decline? What happened in the Asian session? Watch our video review and find out. Wall Street tumbled because of the bearish factors we mentioned in our yesterday's review. The psychological factor played the main role in its collapse. Even the upbeat macro stats published on Tuesday, namely durable goods orders data for March, the house price index for February, and the consumer confidence index for April, didn't improve market sentiment. Apart from that, Tesla shares dropped by 11% following CEO Elon Musk's deal to buy Twitter. The NASDAQ index took a nosedive due to these news. Meanwhile, the first quarter earnings season continues. However, investors are more curious about how aggressively the Fed is going to hike the key rate. This decision is of a high importance as it will strongly influence the sentiment in the equity market. The next FOMC meeting is scheduled for May 3 and 4. Many analysts are betting on a 50 basis point increase. Apart from the news on the national economy, market participants closely follow what is going on in the foreign ones. For instance, they are worried about the geopolitical tensions in Europe and the worsening epidemiological situation in China. This is why it's hardly surprising that the stock market has slipped into negative territory. The US dollar as a safe haven asset is growing steadily amid such headwinds. The US dollar index, which gauges the strength of the greenback against 6 major rivals, has risen above 102 for the first time since March 2020. As a result, it approached a new multi-month high of 102.30. It appears that the US dollar has great chance of hitting 103 points, which is the high of 2020. Moreover, the euro, its main counterpart, is deeply into the bearish channel. It's unable to regain momentum due to the risks of the energy crunch, a higher inflation, worsening epidemiological situation, and China's lockdowns, and the grim prospects for the eurozone economy. In the Asian session, the US currency climbed by 0.3% to 102.73. So there is no doubt that its rally will unfold further. In the morning, it was moving in the upward range of 102.23 and 102.40. It's highly likely to edge higher during the day. The yen managed to partly restore its safe haven status. Yesterday, it advanced significantly amid risk aversion. It returned to 127, and this level looks far stronger than last week's high around the 129 level. Over the past 3 months, the dollar-yen pair has increased by 12%. Demand for the yen as a safe haven currency remains high, especially in periods of a decline in the dollar-yen pair. However, judging by the movements on the chart, the yen retreated today. The US dollar climbed significantly against the yen, so the pair is trading at 128.89. It's also moving in the intraday upward range between the resistance level of 128.10 and the support level of 126.93. As a result, demand for the yen is again moderate. The reason is the same, the widening rate gap between the Fed and the Bank of Japan. At the same time, the Bank of Japan regularly buys on unlimited quantity of government bonds to defend the yield target. And besides, inflation in the country remains at an extremely low level of 0.8%. To this end, traders are likely to wait for comments from Bank of Japan officials before resuming purchases of the yen. The Bank of Japan meeting has already started today. However, the regulator will announce its decision as well and reveal its economic outlook only tomorrow. The Reserve Bank of Australia will also hold its meeting in less than a week, while the federal election is less than a month away. Therefore, analysts did not expect any changes in monetary policy. However, they are not so certain after the release of inflation data. The latest report showed that inflation in Australia spiked to 20-year high of 5.1%. A higher than expected consumer price index may force the Reserve Bank of Australia to raise the key rate already at the May meeting. It will take place on May 3. The cash rate of 0.1% looks rather inappropriate given soaring inflation. As a result, the Reserve Bank of Australia has almost lost its opportunities for maneuver. The Fed stock is forced to take some measures, and the recent drop in the Aussie may also become the reason for the rate hike. However, yesterday it erased some of its losses thanks to rising energy prices, however only partly. Having fallen by 0.6%, the AUD-USD pair slid down to 0.7130, the lowest level of the late February. In the Asian session, the pair gained 0.5%. Apparently, the AUC grew slightly amid expectations of the rate increase. At the moment of preparing material for this video, the pair approached 0.7150, and it was consolidating near the resistance level of 0.7192 and the support level of 0.7123. And that's all for now. Subscribe to our channel and stay up to date with the latest market news. Feel free to leave your feedback and see you soon.